Welcome back. We'll talk about that fun phrase, life insurance, right now. And I think when we talk about that, one of the things is, when I first got my career started, I worked for Northwestern Mutual and had a great experience there, learned a lot about life insurance. And, I think I've got some of those basics down. And, I always took for granted that people understood it pretty cleanly from the top. So I like to kind of get into this. I want to, explain 4 different types of insurances and then some reasons why you would purchase the insurance. So let's take a look at the more common ones. The first one is whole life insurance. And whole life insurance, the way that works, and that's the way all these work, is you have this death benefit. So let's say you had $500,000. There's a price associated with that that's dependent about how healthy you are, whether you smoke or don't smoke, male or female, and your age. And once you put that in, you're going to get a certain amount of premium that it's going to cost you. You're going to keep that death benefit the whole time, and then you're going to develop this cash value on the side that's accessible while you're living. So that's how whole life insurance works. Term life insurance is the next type, and this one's probably the most common. It's the cheapest, and when we think about term insurance, you might be able to get $1 million at age 25 for maybe a couple $100 if you're in great health when you're young. And that's available to you. Usually the way it works is this: term insurance will start low for the price and then increases through time. And then sometimes they'll level them off. So if it's for 20 years, they might increase it a little bit right now and keep your premium level so you don't have an increase every year. But again, it's all about the death benefit. The next one is universal life. Works very similar to whole life, but instead of the whole life cash value is determined by the insurance company, and how they invest it. Universal life is actually based just upon interest rates. So if interest rates are high, that cash value on the side that you have accessible to you while you're alive will increase. If it's lower, it's going to be a smaller amount of money that's there. And then the fourth one is called variable life. And if you think about that, variable life means that that account performance on the side is going to go up or down based upon the investments you choose. So now you're in charge. You can buy international funds, large cap funds. It's almost a certain investment that you kind of put together. The big thing about all of these, it's all about death benefit first. That's what should drive what you have for coverage. Death benefit, time frame, and then get to cost. So something that is very concerning to a lot of people is they say, why would I purchase any insurance besides term insurance? So if we look at the next slide, a lot of people say buy term for the cheap price, and then the difference that you were going to put into that whole life policy, go invest it. And if you look at these two charts, they both have the same things going on, but if this was a little more accurate of a chart, and the cost on whole life, let's say you had a 40-year-old that wanted $100,000, the cost on whole life could be $3,000 a year for $100,000, where it might cost you a couple $100 for the term policy. So here's the difference between that. You could go invest it every year, and if you can outperform the insurance company, that would be very helpful to your benefit. So again, there's an argument both ways. So let's move to the next slide here, what are some reasons? Number one, family protection. Make sure you have the right benefit for your family. Mortgage you want to have taken care of, maybe college, maybe some income. Business continuation would be the next one. If you hold a maybe family business, instead of trying to find an agreement, have life insurance there to pay off the person who's not involved. The estate plan, a lot of times you have large estates that could have large amounts of taxes. Some people will buy a large death benefit life policy to do that. And number four, some people very simplistically said, I can't figure out a way to save, and they use life insurance to develop cash values to save to get tax deferral. Again, this is a mouthful of everything I just told you, but those are some things that kind of lay the land for life insurance. When we come back, we're going to answer a viewer question on Social Security. Stay tuned. Welcome back. We have a viewer question. John from Bristol asks, when I begin Social Security benefits, what are the best ways to decide to take my benefit at 62 versus my full retirement age? So John, what I would do here very simply, and again, you can get into a million different calculations, what I would do is total the amount that you'll get from 60 to 90 in one column, from 67 to 90 in the other column, total those up as they're going through, see when they break even. So for instance, most cases someone will break even at 75, meaning that if you had died before 75, you would have got more by going early. If you live a longer life after 75, you would have got more money after 67. I think that's very important, but sometimes people need the money right away. Consider that. Every situation can be a little different. Use ssa.gov as a good resource. Thanks very much. Have a great week. Thanks for joining us.